Okay, we are seeing participants joining in, so let us start the webinar. So, welcome you all for today's webinar. This is Akshara Menon, analyst at PMS Bazaar. Along with me, we have two guests for today from Emkay Investment Managers Limited. And the topic for today is manufacturing for India forward. So, before jumping into the topic, let me give a brief about today's speakers. To start off with, Mr. Sachin Shah. He's a seasoned, hello sir. He's a seasoned fund manager with over 2 decades of experience in equity markets. By the virtue of his extensive research, such realized early stage on need a framework in which companies with tricky standing needed to be filtered out very objectively, leading to the development of Equal, an EIML properties module, which helps us to evaluate and compare a list of companies on various aspects of governance. To talk about his educational qualification, he's a CFA holder, and he has started his career as equity analyst, and he has also been associated with Motilal Oswal as a vice president. Moving on to the speaker two for today is Kashyap Javeri. Hello, sir. With more than 16 years of experience in company and sector research, Kashyap brings exceptional insights into stock and economy. Prior to joining Emkay Investments Managers, he was a rated BFSI analyst in Emkay Institutional Equities for 8 years and also worked with Shah Limited as a mid-cap analyst. Kashyap brings with him an immense in-depth knowledge, not only on variety of manufacturing and services sectors, but also in banking and economics. Hello, sir. So moving on to the webinar, I have a small request to the investors to put on their questions in Q&A box and not in chat box, and not to ask any stock-specific questions because that wouldn't be taken on air. Thank you, sir. Over to you, Mr. Kashyap.
Thank you, Akshara, and thank you for that generous introduction about me and Sachin. Is my screen visible?
Yes, sir.
Okay, yeah. So Akshara, thank you so much for that introduction. I think over last many, probably almost about almost 7 to 8 years, we've been hearing about a lot of noise about, make in India, a lot of things about indigenization, a lot of things about moving manufacturing here. But I think today is the time when we believe that, India's emergence as a manufacturing powerhouse to us looks more certain probably than ever. We do believe that this is an idea whose time has come. And I think I draw an analogy over here, that in past we have seen that, when stars align, or when, as a part of jigsaw puzzle, so many pieces which are there, they align at the same point of time at the right place, wonders can happen. If I were to draw an analogy for the same, in past where we have seen this. So, just to take a live example, in Birmingham 2022, in Commonwealth Games, we probably won the highest ever medal tally, in terms of any, global games of, Commonwealth. Why did that happen? That happened because if you look at the three parts of the game, which is the player, the coach, and the medals, all were at the right place at the right time at that point of time. And what do we mean with that? So what we mean is that today, if I look at manufacturing and draw an analogy over here, you have the manufacturer for, who is the player for us. You have the government, which is the coach, and you have the consumer, or, for us, that's the patron, or the medals to be won. I think all are at the same place or at the right place at the right time. From the manufacturer point of view, if I were to look at a player, what I'm looking at is the right amount of proteins or right amount of muscles and the right amount of fats. I think that's pretty much in place for manufacturing sector. The coach or the person who creates a conducive environment for the player to succeed, I think he is today more supportive than ever in terms of government. If I look at the consumer, there is more to be won. Not only in terms of, say, the domestic consumer, but I think what we are looking at is actually the global consumer, or, let's say what we are looking at, not only India, but we are looking at consumers across the world, which, probably Indian manufacturer is going to serve. And at this point of time, all three are at the right place at the right time. And when I look at each one of this, how they are shaping up for, this whole, sort of upswing that we look at, in terms of manufacturing over a period of next, probably not 1 year, 2 year, but almost about 3 year to 5 year, and then extending beyond that 5 years to almost probably, next 10 years. Each one of these, if I were to, look at, are getting back in shape in their own way. So if I look at particularly, let's say, for example, if I look at the manufacturer, at this point of time, and when I spoke about, comparing manufacturer with the player, there has been the right amount of, muscles which is being put on, and, the right amount of fats which are being shed. When I look at the right amount of, muscle, what I'm referring to is actually the productivity of the whole sector, and which has been on a significant bounce back. In fact, I wouldn't be wrong if I were to say that, today the productivity of the whole manufacturing sector is probably at the decadal high. And when I say decadal high, there are, two ratios that I'm looking at. One is the cash return on capital employed, or cash return on invested capital for the sector. And the second ratio that I'm looking at is today the capacity utilization. When I look at the cash return on capital employed, which is a simple ratio of, cash flow from operation as a percentage of.
Sorry to interrupt you.
Yeah.
Could you place it in full screen mode, because we could see the.
Oh, sorry.
Extremely sorry for that.
Is this perfect?
Yeah, now it's perfect. Thank you.
So when I look at, the cash return on capital employed, which is simple cash flow from operations divided by the total invested capital in a particular company, today, we are at a decadal high over here at almost about 15% plus, primarily driven by the fact that the other issue that I spoke about, capacity utilization, today at about almost 75 odd percent at the end of Q1, is again, it's sort of a decadal high number. Alongside, what has also happened is that over past about, let's say, 3 to 5 years, and particularly post COVID, the companies have been significantly, having a, sort of razor eye focus on their working capital management. And last but not the least, what has also helped is the fact that if you look at the effective tax rate, because of whatever the government did in 2019 in terms of the maximum effective tax rate, the tax outflows have also been significantly lower for the manufacturing sector. And consequently, the productivity of the whole sector has been on an upswing. The way these manufacturers are utilizing these cash flows, particularly one, obviously, if you look at debt to equity of the whole sector has been coming down. If I look at particularly some of the more, leverage sectors like, ferrous metal or non-ferrous metal, again, there the debt to equity ratios have dramatically come down, which means that clearly what we are seeing is that the manufacturers are also shedding a lot of fats, a lot of this leverage on the balance sheet, which they had, at the beginning of probably previous decade. They have been shedding it, in significant way. And today they are sitting on completely non-leveraged balance sheet at this point of time. So part A, obviously the whole sectoral productivity has been on upswing, and part two, the whole, debt to equity ratio or the leverage of the sector has meaningfully come down over past about 7 to 10 years or so. Are manufacturers utilizing this, newfound optimism in terms of the productivity or in terms of deleveraged balance sheets, in terms of putting up new capacity? I think over a period of time, when we read newspaper, we have been hearing about a lot of numbers. Some of those numbers come from agencies which are, in the business of collecting data on capex. We have been hearing a lot from the government side also in terms of, how the capex has been moving. But I think there is one number which we keep our eye on, and which is the starting point of any capex, which is the environmental clearances. And any corporate who wants to do a capex at any point of time, the first thing that they do is to buy land, and the second thing that they do is to take environmental clearances. And if you look at the environmental clearances which are being sought and granted, today the number at almost about 5,500 for last year. If I look at first half of this year at almost about 6,000 plus, the number is almost about 10x of what we saw probably about 7 or 8 years ago. And once this environmental clearance is come in place, obviously there is a significant, high probability that I would put that the whole capex cycle within the Indian economy has been on upswing. I think the another number that we look at for when we look at whether the capex has been on upswing is the registration of manufacturing companies. And today, with the ROC, the register of companies, the number of companies being registered are one of the highest that we have seen in last about 7 to 8 years. If I put all this together, which is that the productivity of the whole sector improving, let's say if I look at the whole debt to equity ratio of the sector declining, and the fact that this newfound optimism, whether it is reflected in terms of capex, I think clearly the manufacturing sector is today in one of the best health that we have seen in past about 8 to 10 years. A part of this is also because if I look at from the government point of view, which for us is the guy, this person who is sitting behind the player or standing behind the player, as a coach, or as a person who wants to create a conducive environment for this whole sector, I think it's been one of the best actions from the government point of view also, if you look at last about 7 to 8 years. If I break up last about, let's say, 8 years of this new government in terms of the way they have been behaving, the first 5 years, which is between 2014 to almost about 2018, were sort of course correction, or let's say, I would say, they were carrot and stick approach. In a sense that, in 2016, we saw demonetization, which was to put the whole payment system into formal, way. If I look at 2017-18, when GST was implemented, we could clearly see the whole taxation getting into the formal way. From 2019 onwards, every policy that we saw coming from the government point of view has been, fairly conducive to the whole manufacturing industry. And I think in that sense, I would say there are four key points which have been, sort of, I would say, very supportive of the whole manufacturing industry. If I look at point number one, clearly, and some of these things are reminiscent or a sense of deja vu for us, of the previous whole upswing in the economic cycle that we saw between 2003 to 2006, which extended all the way up to 2010, 2011, is that the corporate tax rate has been cut from 33% to 25%. Obviously, that adds a lot of teeth or a lot of muscle in terms of the cash flow which the corporates can plow back into their own growth. Point number two I want to highlight over here is that the government capex growth, which until, let's say, probably 2018-19 used to grow at probably a single digit number. Gradually, now 2018 to 2021, it's been growing in teens. If you look at post-COVID, that number is now actually growing at fairly high teen numbers also. And if I look at particularly probably even this year, in the first half of this financial year, the whole government expenditure growth has been largely driven by all the expenditure on A, roads, B, railways, and C, irrigation and the water and sanitation part, water supply and sanitation part. In 2021 budget, they have clearly highlighted that over a period of next about 5 years, between 2021 to 2026, this number is going to continue to grow at about double digit. Obviously, eventually, when the government capex grows, it has got a feedback loop into the private capex growth also. So the kind of capex growth that we saw between 2003 and 2006 in terms of government capex, if you look at the private capex growth, also grew between the same period at almost about 30% plus. So I think if the government capex is going to grow at almost about double digit over a period of next about 5 years, it should obviously also reflect in the private capex growth, and that should also pick up as we go forward. The green shoot in the private capex we have already seen in last about, let's say, 2.5 years, like I showed you in terms of number of the environmental clearances being sought and granted. I think that should continue to rise as we go forward. The third part of this whole policy response in terms of how it is conducive to the manufacturing sector is in terms of the cost of debt. The cost of debt continued to decline between 2018 to 2021. It started rising post the monetary policy change somewhere around February 2022. Having said that, even if I look at today, the cost of raising money today here in India, even after 190 basis points increase in the repo rate, today the repo rate at roughly about 5.9% is still lower than what we saw pre-COVID. If I look at 1 year MCLR, the marginal cost of lending rate, marginal cost related lending rate for the banks today is still about 80-90 basis points lower than what we saw in March 19 and March 20. So it still continues to remain fairly conducive to the overall manufacturing sector. And last but not the least, there has been from 2020 onwards, in terms of Atmanirbhar Bharat, what we have seen is the announcement of roughly about 2.5 lakh crore worth of incentives, which has come from the government. I mean, in past we would have seen a lot of these announcements which would have been very industry specific in terms of the government support. But for the first time in last many years, what we have seen is that there has been a scheme which has come from the government, which has been cutting across most industries within the manufacturing sector, whether it is semiconductor or EV batteries or component in terms of automobiles, whether it is in terms of mobiles and consumer durables, whether it is pharma, food, textile, it cuts across variety of sectors, and we have never seen that in past. And point number 2 here is that when this kind of scheme has been announced, it's been made very time specific and target specific. So as an industrialist or as a manufacturer, I have to meet the targets within the given time span, and the targets that I've already given, I have to achieve those targets within that time span. Never in past we have seen this kind of scheme coming from the government. Obviously, we are not looking at the benefit of this scheme being limited to the sectors for which the scheme has been announced, but it will be cutting across many other manufacturing industries. So for example, when I look at EV batteries, eventually when we are going to produce batteries in India, those batteries are going to also benefit in terms of forward linkages the auto industry, which can actually produce cheaper vehicles which can be exported to the world, which can produce actually cheaper automobiles which can be sold here in India. When I look at EV batteries, those batteries are also going to use a lot of specialty chemicals. Again, those specialty chemicals can be manufactured in India. So there are going to be backward and forward linkages for each of these industry, and which will also benefit the overall manufacturing sector as such. If I were to put this in number, when we achieve the full potential target output for this particular scheme, eventually that output is going to be equivalent to almost about 4% of GDP at that point of time in FY27. Over past about 20 years, what we have seen is that the share of manufacturing in the overall GDP has been on consistent decline. That share has been taken up by either BFSI or some of the other services. Over a period of next about 5 to 10 years, what we believe is that what happened in case of BFSI and IT in terms of rising market share, both in terms of GDP as well as in terms of their share in indices overall in the equity markets, I think there will be some rollback of that market share in favor of manufacturing over a period of next about 5 to 10 years. Now that I have spoken about the manufacturer as well as the government, how they are back to the one of the best shapes and one of the most supportive government that we have seen probably over last many years. Last but not the least, the consumer. Obviously, I spoke about not only the local consumer but a global consumer. But in terms of, first of all, in terms of local consumer, what has changed is that over past about 7 years, he has been completely missing in action. What we saw was demonetization hitting the overall consumption. Then we had GST. Then 2022 we were stuck by COVID like anybody else in the world. But over past about, let's say, 2.5 years, post the COVID, lockdowns were opened up, we have seen a significant bounce back in terms of consumption driven by two things. Point number A, if you look at last about 7 years between 2014 to 2021, inflation was completely lacking. So if you look at WPI grew at probably about a low single digit number. In some of the years, we also had actually deflationary period. If you look at post-COVID, 2022, we had a significant rise in inflation, and we also fed into the salaries and wages. So 2022 was probably the first year in last about 7 years that we saw the salary and wages rising at slightly higher double-digit growth rate. In fact, manufacturing wages rose at almost about 13.5 to 15%, and which also fed into the overall consumption bounce back. Initially, we thought that the bounce back in consumption last year was more a latent consumption bounce back post the COVID lockdowns opening up, but it's been almost about 18 months and we haven't seen any letdown in terms of consumption yet. What we are also seeing in terms of consumption is, the China plus one policy, where a lot of, production or a lot of global demand in terms of specialty chemicals, in terms of pharma, in terms of textiles has been shifting to India. If you look at now over last about, let's say, 3 to 4 months, what we are seeing is a lot of companies actually talking about shifting their supply chains in terms of Europe plus one. So for example, many of the companies in auto ancillary and engineering goods, when we speak to them in our quarterly conference calls, now they are talking that because energy cost across the globe is moving up dramatically. For example, in Europe they have gone up tenfold. They want to shift a lot of their manufacturing which is done in Europe in some of these sectors, probably to India. So as a manufacturing sector, you are not only going to service the domestic consumer, but also global consumer in terms of, let's say, production capacity shifting from China plus one as well as Europe plus one. If I were to just talk about, what domestic consumption could look like over a period of next 3 to about 5 years, and some pictorial presentation of that. If you look at last about 7 to 8 years, the nominal GDP of this country grew at probably a low single digit to a high single digit number, and inflation over last about, let's say, 3 to 5 years, particularly during COVID, rose significantly. If I look at next about, let's say, 3 to 5 years, and let's say we see a per capita GDP growth of about 11 to 12%, which comprises of real GDP growth of about 6.5 to 7%, and let's say an inflation about 4.5 to 5%. Some of these discretionary spends, which today are not within the bounds of a normal average Indian, could be well within the reach. So for example, if I look at Wagoner LXI model, sorry, today costs roughly about 6,30,000, 6,40,000 rupees on the road. Average per capita GDP of this country is roughly about 1,70,000 odd rupees, which means an average Indian has to spend roughly about 4 years of income if he has to buy a Wagoner LXI model. If the per capita GDP grows at about 10 to 11% and inflation rises at about 4.5% every year, over a period of next about 5 years, that number from about 4 years of salary will just sort of come down to about 2 years of salary or 2 years of income, which means that an average Indian, probably more and more average Indians, would be able to buy some of these discretionary goods as such. Similarly, so on and so forth goes on for, let's say, if I were to talk about, let's say, Royal Enfield Classic 350 model. I could speak the same thing about some of the home improvement products, which are like, probably a television or air conditioners, consumer durables, home refurbishment products like, tiles, paint, and so on and so forth. So I think if I look at today, almost everything which is as a part of this, this whole jigsaw puzzle, which is the manufacturer, the government, the consumer, everyone is at the right place at the right time. Did we see this last time? Have we seen this ever in the past? I think yes. If you go back in 2002, 2003, I think almost the similar type of setup was visible, which was all the three at the right place at the right time in the similar fashion. Obviously, when I look at this whole setup, it does not go without its own risk. So obviously in future, there are some of the risks which are there also to this particular, theme, which are, obviously some, when you associate with manufacturing, these are some of the risks which obviously comes up to one's mind, which is inflation, interest rates, liquidity, and economic slowdown. And each of these, are sort of coming now, becoming more and more, helpful in nature. If you look at inflation, we have seen commodity prices significantly coming down by anywhere between about 20 to 40%. Having said that, if you look at any of our portfolios that we have built over last 12 years of our history, we always invest in companies which have got pricing power and which are sort of inflation proof in nature. In terms of interest rates, again, we believe that there will be obviously an upswing in the interest rate further from here on. There will be some bit which will be still there. Having said that, I think the mitigation is in terms of the fact that all the portfolios that we built in our 10, 12 years of history have always been net cash in nature. And obviously, like I spoke about, the interest rates in India today are still less than pre-COVID in terms of both the policy rates as well as in terms of the lending rates. The economic slowdown risk, obviously, as some of these economies probably face recession or slower growth, there is a risk of economic slowdown. But I think if you look at the companies that we invest, we always make sure that we have a judicious mix of companies that we invest in, which are domestic focused as well as export focused. Having said that, what we are going to see over next 3 to 5 years is that in terms of Europe plus one and China plus one, as the supply chains shift globally, I think even in face of economic slowdown, what we are going to see is that the share of Indian exports probably might rise in the global exports, and which will support the overall Indian exports also as such. Now, to talk about product, let me invite Sachin, to take us through some of the features of this product, and which we believe are very unique, offering that we are bringing on the table. Sachin, over to you.
Thank you, Kashyap. I'm sure after the presentation that you made on the manufacturing sector, the top question at everybody's mind is how do we capitalize on this opportunity? How do we really participate in this opportunity? As many of us really know that in terms of the, there are clearly what you say, portfolios which are extremely heavyweight on a lot of services businesses, whether it's BFSI or IT. And if we believe that the manufacturing as a sector is actually going to outperform over the next 5 years, then how does one really have a focused allocation to that theme, right? So we have this Emkay Emerging Stars Fund Series 5 that we have recently launched. This is going to be a multi-cap portfolio investing across large cap, mid caps, and small caps, but focused on the manufacturing sector. And like all our portfolios till date, we will have a very diversified but a focused portfolio, avoiding any kind of concentration risk. So our sweet spot has always been about 20 odd stocks. 18 to 22 has been our sweet spot for most of our portfolios, as some of you might already know, like in our Emkay Emerging Stars Fund Series 1, 2, and 3. In fact, I will also talk about our performance that we've delivered over the last 5 years in our Series 1, 2, and 3, and also in Series 4, which we recently launched just 1 year back. So coming back to Series 5, Series 5 is a portfolio which we will be investing across the manufacturing sectors, be it auto and auto ancillaries. It could be chemicals, pharmaceuticals, engineering, power equipment, electronics manufacturing, maybe sometimes textiles. So wherever we see some very structural, strong story for the manufacturing sector over the next 5 years is something what we are really focused about. The benchmark for this portfolio will be the Nifty India Manufacturing Index, right? So one of the key reasons why we have actually kind of designed this portfolio is, as I was saying earlier, that in most of the portfolios today are very overweight or heavyweight on the services side, right? Because today BFSI and IT are two of these sectors. In most of the indices, most of the large cap indices or most of the broad-based indices are nearly 55 to 60%. And by default, most of the portfolios tend to kind of have similar weightages to the benchmark indices. And that's why, we believe that the manufacturing as a sector is relatively underweight for most of the portfolios. And to get that right focus, we have created this Emkay Emerging Stars Fund Series 5, which we believe will probably outperform quite significantly over the next 5 years. In fact, when we look at the track record over the last 15 to 20 years, the manufacturing as a sector has always been outperforming. It's just in the last 5 years, which is FY17 to FY22, the manufacturing sector has kind of underperformed to the Nifty. And probably the reasons are because it started with demonetization, post that there was GST, and then of course after that COVID. So every time the manufacturing sector in the last 5 years was trying to actually bounce back, there was something or the other which kind of suppressed it. But like as Kashyap mentioned, that in the last 5 years, although externally there was challenges, but the sector or the companies within that sector have actually created a very strong foundation for an inflection point that we are really observing at this point in time. And we believe that because of the deleveraged balance sheets, because of the strong high capacity utilizations and the cash flows that the companies are generating, we are at an inflection point where the manufacturing sector is probably going to see a very strong growth over the next 5 to 7 years. In fact, we sometimes internally discuss that probably this is going to be a virtuous positive cycle that we are entering into, and this theme can actually go on beyond 5 years, maybe 7, 8, 10 years also, right? What we also have, why we are also confident in terms of our portfolio management or fund management is that we already have at MK, we have already been managing this manufacturing based portfolio since almost 1.5 years or so. And we have delivered very, very decent returns over this last 18 months plus. So, and of course, our track record on the AIF 1, 2, 3 and other capital builder flagship PMS strategy. Uh, some of the businesses which we believe are very, very strong opportunities. Kashyap spoke about the China Plus One opportunities that we can see. So companies like Divi's Lab, Timken, Sundaram Fasteners, Naveen Flooring, even on the domestic side, companies like Grindwell Nortel, Varun Beverages. And some of you might think that why do we have some of the services name out here on the logistics side? But some of these companies on the logistics sector are completely ingrained with the manufacturing sector. So a company like VRL Logistics, Mahindra Logistics, all their customers are all our manufacturing sector. So we are very open to looking at some of these opportunities also. In terms of our track record, these are some of the businesses that we have invested over the last 5, 7, 10 years, particularly in the manufacturing sector, and they have done really well for us. They have delivered good outperformance and helped get alpha for our overall portfolios. Again, some of these names, why did they do so well? So, as we can see for a company like Varun Beverages, clearly the global franchisee and the way they have executed on the distribution side in this country, I think it speaks a lot. Divi's has been, one of its kind business. They have actually been getting a lot of businesses from the global pharma majors over the last 15, 20 years. And they are investing humongous amount of capex. In fact, I think that whatever capex the DVs might have done in the last 10 years, probably they will do more of that in the next 5 years. So that's the kind of the growth opportunity that we are seeing. And similarly for most of the other businesses is what we are witnessing at this point in time. Just to give you some nuances of this fund, this is a AIF category 3. This is a 5-year close-ended fund. It's a multi-cap investing in manufacturing sector. The first 12 months will be hard lock-in, and after that, every quarterly, there are going to be redemption options for investors if they would like to do a pre-maturity exit kind of a thing. I would also like to share with each of you our performance on the MK Emerging Stars Fund Series 1, 2, and 3. This was the fund that we launched in the calendar year 2018, January 2018. We are almost at the fag end of this fund. We are nearly 4.5 to 5 years. Happy to say that we've delivered very decent returns. We are almost 1.9x is what we've delivered to investors. And an XIRR of 17.6%, nearly 17.5 to 18%. More than that, we are also happy to say that we have already returned 115 to 120% of the invested capital to the investors, and the balance is also going to be returned to the investors before the end of this calendar year. We are already on that path, and we are quite confident that we'll be able to do that. So in the entire 1.9x in terms of the portfolio value that we are seeing is not a notional thing, is something that we have already realized. And this was a small cap focused portfolio. Calendar year 2018, we had launched 3 series, Series 1, Series 2, Series 3. All of them are mirror image, and all of them have delivered returns similar or better than this. In fact, Series 3 has delivered more than 20% XIRR. MK Emerging Stars Fund Series 4 is also a small cap focused fund. We launched that in August 21, and that portfolio also continues to outperform by at least 600 bips since inception over the last 13 to 14 months. So this is what we just thought we'll share with you. We will now be happy to take any questions. Open to you, Akshara.
Thank you, sir. Thank you for the wonderful webinar, the PPT as well. We've got a few questions to start off with your experience from your earlier AIFs. Explain how do you build a portfolio in different market conditions?
Yeah, that's a very, very interesting question. Akshara, if you see, as I just mentioned, that the last 5 years back, calendar year 2018 is when we launched our first AIF1, calendar 2, I mean AIF series 2 and AIF series 3. Now, if you think about it, the last 5 years, if I'll say was a roller coaster, will probably be an understatement, right? 2018 is the calendar year when we saw quite a meltdown of the valuations, particularly in the mid cap and the small cap space. In fact, when we look at the data points, you will see that from I think January 2018 to March 2019, in that 15-month period, the small cap index was down 25%. Then 2019, when the valuations became very reasonable, we all of a sudden saw that the economy started slowing down. The Indian economy was, the growth rates really slowed down quite significantly. Early 2020, which is January 2020, February 2020, we saw the green shoots coming back in the economy. Valuations were very reasonable. And then, of course, March 2020, we all know the COVID happened, and there was a absolutely unprecedented global lockdown, and not for a few days, few weeks, but for a few months, right? That was absolutely unprecedented, right? So we had a quite a, I would say, dramatic kind of a time in this last 5 years. But of course, as they say, all is well that ends well. And as you have seen the returns that we've delivered 1.9x. So to my mind, what really worked during this 5 years has been largely that our focus on the quality and discipline, right? And when we talk about quality, we've been always extremely focused about quality of the management and quality of the business. So when I say quality of the management, we have our own proprietary module called Equal, where we we very objectively evaluate managements on management integrity, management capability. How has the management distributed wealth to the minority shareholders? How has the management transparent enough to share the information with the shareholders? And of course, then liquidity also plays an important role. Over and above that, of course, quality of the businesses. So when we talk about the quality of the businesses, Kashyap spoke about how the balance sheets have got deleveraged, how we are focused on the cash flows of the businesses, how we are focused on the inherent profitability of the businesses, the ROCs and ROE, because we strongly believe that these are actually the fuel for growth. We all want higher growth, but for higher growth, one needs to make higher investments. And when you can make higher investments from your internal accruals, it's a very, very strong foundation, right? So I just mentioned a company like DV's Lab, which has done humongous amount of investments in the last 15, 20 years, and probably did do much more in the next 5 to 10 years. But the best part about it is not the kind of capex that they're doing, but the entire capex is internally funded. It's a debt-free company. And when they do capex for 2,000, 3,000, 4,000 crores, and they are able to generate that from the internal cash flows, because their ROEs or ROCs are upwards of 20, 25, 30%, which allows them to actually build a very, very strong foundation for the next 5, 10, 15 years. So we are extremely focused on investing in those kind of companies. And that's where, we've had our outperformance, and that razor sharp focus will continue. And that is something what we are very confident about, that, irrespective of the market cycles, as long as we are having the right quality of businesses and managements in us, and the discipline, right? The discipline part comes in terms of the portfolio construct, right? So in terms of the allocation discipline, no single stock probably can be more than 7 to 10% if it's large cap, not more than 5 to 7 if it's mid cap, not more than 2.5 to 5 if it's small cap. No single sector allocation should be highly overweight or skewed towards that. Those kind of allocation disciplines, and discipline not only during the investing time, but also during the divesting time, right? Because as I said, that we have these funds which are getting matured in 2023 across the time frame of January, March, and October. But we've been very disciplined of, gradually liquidating our portfolio since the beginning of calendar year 2022, because we don't want to take a risk at any one point in time. And, we have been very, very focused about how we also liquidate the portfolio so there is a least impact because of our large holdings getting divested in the markets. So I think focus on the discipline and the quality is something what we'll always be at the top of our agenda, and we'll continue to do that.
Thank you for that. We have one question from Anurag Shukla. Is that as manufacturing sector continues re-leveraging, would it be a good idea to play out the theme by investing in more commercial facing banks as they seem attractive and comparatively safer bets?
Yeah, Kashyap.
Yeah. So I think as the manufacturing sector itself expands, eventually there will be the re-leveraging, as one calls it, right? Having said that, particularly from this let's say manufacturing sector focused portfolio point of view, uh, there is no commercial bank, or let's say if I look at to put it in a different manner, any bank that you pick up today uh, within the investable space, almost 50-55% of the book will be actually retail, which is more, let's say, consumption focused or more personal expenditure focused. So in a sense, from the point of view of the portfolio, we are not going to invest there. From, let's say, a different portfolio point of view, which might be, let's say, a generalized portfolio, I think over a period of time, as a secondary advantage or a secondary beneficiary or a secondary derivative of the manufacturing, the banking is bound to do well. So I think in that sense, as a secondary derivative, obviously the banks are going to benefit out of this whole manufacturing thing, because as you do capex, obviously beyond a point of time, doing capex from own or, let's say, internally generated cash flows may not be possible through eternity. So obviously some of these corporates are going to borrow debt up to probably the extent that they might be comfortable with, and some of these banks are going to benefit out of it. But having said that, I think in the initial period, what we believe is that to fund this kind of capex, some of these smaller banks might be probably once bitten twice shy, because they have burned their fingers in some of these syndicated loans between the period of 2000, let's say 13, 14, probably even extending up to 2018. So initially they might be shy of doing that, but eventually, obviously, yes, some of these banks will have to do commercial lending, and as a secondary derivative of manufacturing, they are probably going to benefit out of it.
Okay, thank you. Thank you. Anurag, I think your question is answered. So moving on to the second question. How do you see valuation of the current market, and why has India been more resilient and that emerging market peers?
Sure. Let me take that up. So obviously, valuations of all the emerging markets have actually been pretty resilient, right? So if you look at, probably some of the other markets within the emerging, I think barring probably South Korea, we have all, and the Chinese markets, obviously, we have all done significantly better versus the the developed markets. And primary reason is that it's very obvious that the difference in inflation between the developed market and emerging markets today is one of the widest that we have ever seen in the history. It used to be actually reverse, right? That the emerging markets would have inflations which are higher points, and the developed markets would have inflation which would have been at significantly lower number. That differential today is reversed, that emerging markets probably are seeing lower inflation, and the developed markets are seeing fairly high inflation. And I think that also is reflecting in the ferocity with which the rates are rising there, and the ferocity with which probably rates are rising here. We have been significantly slower, and which is also reflecting in the valuations of the emerging markets versus developed markets. Within emerging markets, India has been doing phenomenally well, in fact. So if you look at valuation differential between us and some of the comparable countries, which are like probably Brazil or Indonesia or Thailand or Taiwan, we have been quoting at premium. But that premium also comes with a fairly high growth in the earnings also, right? Because if you look at each of these countries, some of them are driven completely by exports, which means that as the global economy slows down, and their share in the global exports are significantly higher, they will bear a higher brunt of the global economic slowdown. Some of these economies are actually driven by commodities, which means that as the commodity prices also, sort of come down, and rather which have come down dramatically, the earnings growth in some of these economies will also slow down materially. Within that, India actually stands out, completely, because of two things. One, our earnings are more domestic driven, and point number two, even in export driven earnings, our market share in the global market or global export market is significantly lower, which means that as the supply side, supply chain shift from Europe or from China to us, that part of the earnings is also significantly safeguarded. So what you are going to see is fairly higher earnings growth compared to, obviously versus developed markets, it's obviously going to be higher, but versus a lot of these emerging markets, which are either export focused or which are commodity focused, our earnings are going to be more resilient, and the growth probably will be much higher, and which justifies the kind of valuations that we are seeing today. If I look at particularly even in case of manufacturing, today, despite whatever said and done in terms of the run up in terms of, let's say, Nifty India Manufacturing Index, or in terms of BSE India Manufacturing Index, that particular index today still stands at significant discount to its historical highs. This particular index used to quote in past at almost 30-35 times trailing earnings, and if I look at the similar index today, the valuations are anywhere between 21 to 22 times. This number is available for anyone to see on BSE's website also. So in that sense, the valuations today, if I compare for particularly manufacturing vis-a-vis its own past, it's still at significantly lower than what it used to quote at historically. And its own discount or premium to even Sensex is today, probably in favor of investors. So I think valuations, yes, are high when you compare with, let's say, some of the emerging markets, but the resilience of the EPS growth and the quantum of the EPS growth, both are also materially different versus any of these emerging markets.
Thank you, Kashyap. Jacob has one question. How do you filter and select stocks? Probably wants to know about the stocks selection philosophy behind it.
Sure. Thank you, Jacob, for that question. So, I just spoke about our proprietary module Equal. That has been one of the big filters for us. And we've been using this filter for more than 10 years now. So with a lot of confidence and satisfaction, I can say that this Equal, our proprietary module Equal, has really studied us very well throughout this last 10-15 years. When we've seen at least maybe 150 to 200 odd companies where we've had a lot of corporate governance challenges, and we've not even had one single company, if it has been at any point in time of our portfolio, where we've had any corporate governance challenges. So Equal has been a very big part of our process. Equal is basically a process which helps us determine the management quality. And within management quality, again, we very objectively try to evaluate companies on management integrity, management capability, wealth distribution to minority shareholders, investor information, and then of course liquidity. So, and there are multiple parameters which are from publicly available data points, and there is a scoring that helps us decide whether we want to invest in that business. So on a particular scorecard, because it's all publicly available data information, we can compare companies across apple to apple. And if there's a score, say below 50, we would not invest in any of those businesses. Or say, if there are certain red flags that we've created, say if a promoter holding pledged is more than 70%, we would not invest in that company. Or say a debt equity of more than 2.5 times, we would completely avoid investing in those companies unless it's a BFSI where the inherent business is about financing, right? So, some of these parameters really help us. The other part of the thing is that, we look at companies which generate very decent amount of cash flow. So I mentioned that, when we are evaluating companies, our focus is on cash flows, second balance sheet, and third is P&L. So we are always very closely monitoring and understanding how the cash flows of this business are, where these cash flows are going in the next few years. Is the operating cash flow going to culminate into a free cash flow over the next few years, is something what we are extremely focused about. And then of course we also look at the industry opportunity, because Indian equity Indian economy is all about growth. Indian stock markets respect the most where there is growth. And for the growth to play out in the businesses that we invest, the industry opportunity has to be very large. Understanding the industry structure, how big is the unorganized, how big is the organized, what is the potential of unorganized getting into organized, or are the top 3-5 players having a decent market share? Is it already a consolidated market? All of these things really help us understand. Also looking at the inherent profitability of the businesses in terms of the ROE and ROCE, because this is the fuel for the future growth. Management quality, as I mentioned earlier, but also the strategy. It is also important that the managements have the big picture, they have the big vision. Otherwise, they'll miss the woods for the trees. That is also important. And then, of course, execution. So these are some of the key things that we are extremely focused about, which helps us understand the businesses. And then, of course, the last part, which is a combination of art and science, is the valuations, right? Because it's in equities, it's not about hitting a six, but it's about avoiding mistakes. So we are very clear that we want to avoid two kinds of big mistakes that most of the investors would do. First is investing in the wrong promoters or the wrong managements, or shade wherever there is the corporate governance challenges. And second is investing when there are frothy valuations, right? If you bought something which is good, but if you bought it at the wrong price, it will be difficult for one to make a very good return. So these are some of the filtering processes that we are always focused about.
Thank you, sir. Jacob, I think your question is answered. With said that, it's more like a follow-up question. What are the potential headwinds to the portfolio?
Sorry?
To this portfolio. What are the potential headwinds to the particular portfolio?
Right. Okay.
Right. Yeah. So basically there are 2-3 things which could probably have some challenges, but we believe that India is in a better position. So like one is that we all have been talking about the global recession, right? I'm sure that will have some, if that really plays out in a very big stream, if it really widens and all of that, yes, there will be some impacts out there. But again, as Kashyap also mentioned earlier, today kind of the geopolitical challenges that the world has seen, I think most of the global sourcing managers are very clear that they need to create alternate supply chains, right? And there are certain industries where India has proven its domain expertise. India has proven that it can give scale. India has proven that it can give quality. India has proven that the customers can be rest assured as far as the protection of IPR is concerned, the intellectual property rights, right? So, industries, whether it is chemicals, pharmaceuticals, auto ancillaries, textiles, electronics manufacturing now, even a hardcore engineering, some of these industries, India has very clearly demonstrated the advantage of, being India the hub for the country, hub for the world and some of the regions, right? So that is where I think, in spite of some small phase, maybe a 2-3 quarter where there will be some adjustments of the slowdown in the world, beyond that, we believe that Indian companies will get a very lion's share of the incremental business. And that is where, irrespective of the global slowdown, we believe that things will play out, right? I think there is one more challenge that we were thinking about is in terms of the, the inflation side, right? So, when Kashyap spoke about that, we are seeing that most of the commodity prices are cooling off, right? But I think also there is another interesting thing, and that is again completely based on our manufacturing theme, that, if you go back to the Indian economy itself, sometime in 2011-12, we saw some inflation coming back very strongly because the demand was good, but at the same time, the supply did not keep up the pace. So, the supply side got chock-a-block, and which actually created a very, demand side inflation. This time we believe that along with the demand, the supply is going to take care of it. Supply is going to keep pace with the demand, and which will allow the inflation not to go through the roof like we've seen in the past. Along with that, because of slowdown in the global economies and particularly the Chinese economy, the commodity prices will remain under control. And that will also allow the manufacturing sector to play out and deliver its productivity and continue to generate very high volumes, because the aggregate demand destruction will not happen because of high inflation.
Thank you. Thank you. Moving on to the next question. What are the overweight and underweight sectors of this portfolio?
Yeah, again, that's an interesting one. So, among the underweights, of course, the BFSI and the IT sector will not be part of our portfolios because they are two services. But even within the manufacturing space, at Emkay Investment Managers, generally, we've been a bit skeptical when it comes to investing in commodity kind of businesses, right? Because that is something where we've not seen a decent amount of wealth creation for investors on a sustainable fashion, right? So commodities or deep cyclicals are some of these, or metals, those kind of businesses is something that we will be avoiding in this particular strategy. And in terms of where we will be focused or where we'll be overweight, clearly auto ancillaries, chemicals, pharmaceuticals, engineering, electronics manufacturing, defense. These are some of the opportunities we believe have a very, very because when we talk to some of the managements of some of the companies in these sectors, what we hear from them is that the demand not only on the domestic side is very strong at this point in time, but also on the export side, the China plus one opportunity that we all have been talking about all these years. They can clearly see that the inquiries are actually converting into orders. So the order books are very, very strong, which will get executed over the next 2, 3, 4 years in some of these sectors. And that is where we believe the wealth creation should happen for investors.
And I think one sector which also again we are quite skeptical of is investing directly into realty stocks, right? So that's also going to be significantly underweight, but we more likely than not we will make that up with home improvement sector within the manufacturing.
Okay, thank you. We'll come to the last question for this today. What is your view on increased logistics and freight costs? Is it here to stay? Your view on it, sir?
Yeah, Kashyap, would you like to take that?
Sure. So if you look at post-COVID, we saw a significant spike first because if you look at globally, there was lack of availability of A, containers, and B, again, lack of availability of ships itself. Then it got slightly taken over by also the fact that the crude oil prices shot up. So you had all the automotive fuels, the prices which shot up, and consequently it also impacted the overall freight and logistics costs. Having said that, if you look at last about probably a couple of months, at least globally, the logistics cost or the container prices have been steadily coming down, like what has happened with respect to commodities. Also, the same thing is now happening in terms of the freight rates. I think in terms of domestic logistics cost, as we see the benefits of lower crude prices, coming to the automotive fuel prices. That's part A. Point number B is that within the overall logistics, as the mix of rail versus road sort of improves in favor of railways, which we have been seeing for last couple of months now. And part C, as we saw, as we continue to see the benefits of more improved supply chains because of the streamlined GST across the country, those costs are bound to come down. If you would have listened to our own the Ministry of Transportation or Minister of Transportation, Mr. Nitin Gadkari, he has been pretty vocal about how exorbitant the logistics costs are there in India versus, let's say, globally. And as we see more reforms on that side, like for example the dedicated freight corridor, as we see more reforms towards that side, in terms of the connectivity between direct connectivity between large metros in terms of roads, I think that cost is bound to come down over a period of next about 5 to 10 years. One of the reasons why probably China could win the global manufacturing supply chain was because of completely unclogged or cheaper logistics also, right? Something that we are going to most likely be able to repeat that in case of Indian manufacturing also.
Okay, sir. Thank you. So with that, we have come to the end of the session. Thank you for this insightful webinar. There are a few questions that are still not answered. I would like the participants to mail to PMS Bazaar so that we will get that answered and we'll reply you back. Thank you for the patience and have a great weekend.
Thank you.
Thank
Thank you,
you.
everyone. Thank you.
Thank you, everyone. Thank you so much.